builders do what they've always done. They keep building until the economy falls off the face of the earth, and then they can't stop. It's like trying to pull a snowball going down the hill. You can't stop it.
Hello, everybody. This is Jake Stenziano, host of the Wheelbarrow Profits Podcast, here with my co-host, the multifamily mentor, the coach, the chef, the father, six, the best-selling author, the G-Daddy, Gino Barbaro. Gino, how's it going?
Mr. Stenziano, how are you doing? What's going on today?
Hey, I'm excited because we're talking for the YouTube folks out there, this bad boy, the oldie but goodie. We're talking a little Wheelbarrow Profits today. We're talking buy right, manage right, and finance right. We're talking the framework, right? We are getting into this bad boy. We're revisiting it because the market's changed, and we want to make sure that we're continuously updating this thing. This is a proprietary framework, and this is a Jake and Gino only episode today. So you are getting the meat and potatoes. You're getting actual content, and we are bringing the panya. That's it.
Ready?
I'm ready. So
I just want to thank everyone out there who's listening, taking time out in their busy day to listen to Jake and I. We are going to bring actionable content that you can use in your daily lives.
So guys, let's get into it. If you go to, we'll just hit it. Chapter 7, buy right, the first leg of our framework. We put this in place because we really believe that multifamily investing is a three-legged stool. It comes down to buy right, manage right, and finance right. If you can get those three legs of your business correct and you can execute on each of them, we think it's going to put you in the best chance for success. Now, when it comes to the buy right, we have parameters. We have certain metrics that we like to hit. Going back when we were coming out of the Great Recession, we were only looking for 8 caps. Well, unfortunately, as investors, that's shifted. So now that's pushed up, and we're landing anywhere between a 6.5 to 7 cap now, if we're being realistic with ourselves. We'd love still an 8 cap. We've actually been able to knock a few out from time to time, but it's very hard to find for quality assets. So the key to it is putting parameters in place that meet your buying objectives. So where do you want to be for a cap rate? Where do you want to be for a debt service coverage ratio? Where do you want to be for a cash on cash return? The buy side has to have parameters built out. And at some point, you have to really look at these and make sure that you're not just forcing a deal because you want to get in the game or you want to get into your first syndication. It's being very disciplined and making sure that your parameters check out. Now, the area that I see most new investors struggle with or get burned on is not appropriately evaluating the expenses. A lot of times when you're looking at expenses, especially with these more sophisticated groups, they'll show zero supplies because they're putting it all under capital expenditures. Or you're seeing some of the smaller companies that just will say, yeah, you don't need a management fee or this, that, and the other thing. So you got to really do a full budget on the front end, or you're not going to get the correct number for your expenses because so many times accounting makes things look less than they truly are. And at the end of the day, that's going to affect your bread and butter, which is your cash on cash return.
Let's go back real quick on the first thing with buy right. I think every investor out there, especially newbies, has to choose a market. Let's select the market that's going to work for you. If you're in California, that might not work for you. You might be buying 4 caps. You might have to go out of market. But let's say, for instance, you're in Cleveland. I love to pick on Cleveland. It's a great cash flowing market, right?
Cleveland.
I mean, it's a great cash flowing market, right? But it's more of a linear market. You're not going to get that capital appreciation. So if you're looking for cash flow only, that market probably works for you. Maybe, the appreciation will come by forcing the NOI, but I mean, it's not a big job growth area. So just be careful of what market you're selecting. We like the Southeast. Why? Jobs. I mean, if you go look on whether it's Berkadia or Cushman Wakefield or any one of these sites that have market data, see where the jobs are going, because multifamily is tied to jobs and job growth and even population growth, because you want more demand, obviously, for rentals. So you're looking for jobs, population growth. Don't be afraid of going out of market. You can find people you can find partners and people to help you go out of market. The other thing I like to look at, when you get into a specific market, choose one market. Don't go into 2 or 3 or 4 different markets when you're first starting out, because it's hard to evaluate a cap rate in California as opposed to a cap rate in Cleveland. They're going to be completely different assets, completely different, I think, what you're looking for on your exit strategies. So assess the market. That's the first thing you need to do. The next thing you need to do on the buy right is start to build out team members. What team members are you going to need? Obviously, the first one and the foremost one are brokers. You need to build out the brokers. And then from the brokers, we'll share a team pyramid of what we do. You're going to have a bunch of other people where you're going to need it on your team to be successful. And the real estate broker can start referring people to you, whether it's a property management company, whether it's a title company, whether it's an insurance company, landscapers, contractors. All those people are going to have to be brought onto your team.
Yeah. And the other piece of the buy right that's crucial is that we look for motivated sellers that are mom and pops. Now, mom and pop sellers come in all different shapes and sizes, but the key with mom and pops is that they don't have the systems in place. We just did a deal. It was 132 units. It was a husband and wife that owned it and tried to run the property as well. Well, the area that we're going to see the biggest pickup in our net operating income is by putting systems in place with professional property management. We'll get to that in a minute, but that's the key, is uncovering those deals that don't have the systems in place, that are undermanaged, that have rents below market, and that you're going to be able to drive the NOI. And that's where we've succeeded, in all of our deals. So that's one of the real keys on the buy side, is try to find the motivation. Why are these people selling? Are you buying from a big REIT that is just repositioned it and they're trying to exit now between years 7 and 10? Or is this truly a motivated seller where there's going to be meat on the bone?
I like that point. I mean, when you're buying, what are your parameters? I mean, first of all, let's get to what a cap rate is. I mean, simply put, a cap rate is a rate of return based on not any debt on that cap rate, right? So you're trying to evaluate a property A and property B. Cap rates, let's look at cap rates. You only want to use cap rates on bigger properties. It's very hard to use a cap rate with 10 units or 5 units or 8 units. Cap rates are used on larger properties. What you want to do is you want to find out what the cap rate is in your market on these big assets. And how do you find that? Brokers are going to give that to you. The other number that Jake talked about was the debt service coverage ratio. Let's go over that really quickly. Now, what is that? Debt service coverage ratio is your net operating income divided by your debt service. So let's say your debt service coverage ratio is a 1.0. That means you're making just enough money to pay the mortgage. Obviously not a good thing, right, Jake? You banks are typically looking for 1.25, which means it's 25% more of net operating income than debt service. So you have enough money to pay the bills. Be great if you can go to 1.3, 1.4. That's what we're looking for. That's what we like to look at. I think the other thing that we like to look at when we look at a deal is we're buying it on actual numbers. Look at what the trailing 12 are on these properties, and you need to look for value adds. What is a value add, Jake? To me, simply a value add is the ability, and you're going to hear from all the brokers, you can raise rents. Can you truly raise rents without spending $10,000 a unit? I mean, I guess you could. Just be careful what brokers tell you. Trust, but verify.
And when you're talking comps, Gino, check your comps in your market. Not your sales comps, check your rental comps. Rentometer.com, see what other apartments are renting for, or go on and apartments.com and see what similar apartments are renting for in your market. That's going to tell you if they've renovated it and they're getting $150 more per unit. That's going to be your lead indicator that, hey, maybe I can do this too.
So when you're looking at income in these mom and pops, fortunately for us, they are really light on the additional revenue side. Jake and I have found out that you can add an additional 10 to 15% on your income just by charging application fees, pet fees. Jake loves the move-in fees, right? Non-refundable
bread and butter, baby.
Storage fees, late fees, all these fees add up. That can add an additional 10 to 15% of income that they're leaving on the table. So that's one value add. The other value add, like we said, is let's talk about that income. Is it really $500 for a one bedroom, or can you get $550? I don't know. We love rubs. A lot of mom and pops do not want to bill back for water. Don't know why, but that's another value add. And I think one of the bigger value adds also is the expenses. On most of the mom and pops that we took over, there was a lot of leakage, and not water leakage. I mean, expense leakage. You're talking about like the contract services, pest control. You're talking about landscaping, even payroll. A lot of those services were really expensive. We know in our market, it's about $4,000 to $4,200 per unit in expenses per year to run a property. Now, if you see a mom and pop running it at $5,000 per unit, ding, 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 there it goes. Take a look at that. And there's one thing that I forgot to mention about cap rates. Everyone's, hating on the fact that cap rates are really low, but when you get a property, you're repositioning a property at a low cap rate, it's nirvana because the value of the property is going to go up. Let me give you a quick example. $100,000 NOI, a $10,000 NOI increase on a 6.5 cap property is going to increase the value by $166,000. It's a little counterintuitive. Stay with me. $10,000 NOI at a 10 cap, the value only went up $100,000. So in this climate that we have right now, you're buying them and they're more expensive. But when you're fixing them up and repositioning them and either selling them, that value is going to increase dramatically. So you know what? When people say, well, you like low cap rates, I love to buy, obviously, when the cap rates are high. But I love to reposition when the cap rates are low.
You like to refi at low cap rates, right?
Right. That's what the nirvana is. That's why these guys are overpaying, right? They're actually going in. And that's one of the questions, Jake, maybe you can address this. Let me touch on this real quick. People say, well, how much should I overpay if I know I'm going to make value? Well, I mean, people are not really buying cap rates in this market also because they say, you know what, if I can buy it at a 4 cap and exit it at a 7 cap, is it okay if I'm paying, a point or more, 2 more in cap? Obviously, that's up to you. That has to worry about what your parameters are. I would pay a little bit more if I know there's that tremendous upside.
But I think it's about the market. So we don't currently operate in high growth markets like Nashville and Atlanta because the cap rates are so low, and we buy for cash flow today and we force appreciation tomorrow. That's our strategy. So if the next time there's an economic downturn, I'd love to go get into some of these high growth markets at that point and then ride it out. But we need to make sure we're buying for cash flow, and that's our strategy and that's our buy strategy. So we want to buy today and make sure the cash flow is there, and then we'll continue to tweak our management strategies to continually force appreciation. But that's why it's something that comes from your investment group, and how are you going to do it? That's why we challenge everybody to put their parameters in place and buy in what makes sense for you. And we're just sharing our principles with you, on this call. So.
And it's funny that Jake mentioned those 2 markets. Atlanta is traditionally known as a boom and bust market, right? So right now they're booming. You can see it's a really weird time for them because they have so much inventory coming online, and it's not really being absorbed as quickly as it should, but they have such job growth and such population growth that it's sort of overtaking them, right? So they're staying up. But when the economy slows down and those jobs slow down, that's going to go to bust. So just be careful right now. They're in the hyper supply part of their market. They've been there for a couple of years. So I keep thinking, when's it going to change? I don't want to buy in that market if I'm not sure and I'm not getting a really good deal. Jake and I are always trying to limit our downside risk. For instance, we bought a property about a month ago. We bought it for $26,000 per unit, these 1 bedrooms. Do they need work? Yes. But we're going to get them up to about $29,000 per unit once they're repositioned. But we're going to be getting $600 a month for 1 bedroom. So you can see the numbers really work. We're limiting our downside risk. If the economy shifts and cap rates go back up, we really don't care because we're holding for the long term. We're going to refi this within the next 18 months. So we're hoping that it holds off. But if we can, we're still going to hold on to this thing. It's still going to be able to cash flow. We're still going to be able to pay our debt. So just be careful what your strategy is.
Amen, G-Dad. Amen, brother.
Dude, it's tough. These markets are tough. Even Nashville is cranking right now. But you know what? When that economy turns, all of a sudden things stop. And builders, what do builders do? Builders do what they've always done. They keep building until the economy falls off the face of the earth, and then they can't stop. It's like trying to pull a snowball going down the hill. You can't stop it. So we all see it coming, but we don't know when. Are we in the 7th inning, Jake? Are we in the 8th inning? What inning are we in? We're not sure.
We're not calling for Mariano yet.
It's really risky. Enter the Sandman, bro. My son's getting really good at that, dude. Really awesome on the guitar. So we're not sure. So if you were in Nashville 3 or 4 years ago, great. Right now, it's a little risky. Just watch out what's going on with people delivering in the market, how much inventory is coming on, and just make sure that those jobs are still coming into the market.
Absolutely. Hey guys, we're going to take a quick time out and hear from our sponsor. Gino, I know a lot of the listeners are wanting to take their multifamily investing business to the next level. I know you've been hard at work helping Jake and Gino students do just that using our framework. G-Dad, explain to the listeners how they can get our help.
Guys, we've been hard at work growing our community of like-minded investors, and the results of our members has been nothing short of incredible. We're looking to grow this amazing group of investors. What we're looking for is those that want to follow our proprietary framework we've created: buy right, manage right, and finance right. Leverage our connections, education, and mentorship as ways to take your business to the next level.
So if you're interested in finding out more about how you can become a part of this amazing community, apply to work with us at jakeandgino.com/apply. All right, and we're back. Gino, this stuff is just great because it puts people, with a framework and a roadmap to really put their parameters in place, which we touched on. I just want to give a little bit of a recap here because the key to it for me is always finding that motivated mom and pop seller on the front end, or finding some type of value add where I know I'm going to be able to buy for cash flow today and then force appreciation tomorrow. So that's what we're really looking at. We like to buy on actual numbers. We don't like to buy in pro forma because we know that the pro formas are always very aggressive. So when we're looking at these deals, we want to know what on the front end, what is the actual income, and then we do the budget. Okay, we set the budget in place for how much it's going to cost us to operate it, and then that's how we're really setting our price when we're going in with an offer. I think it's very important to be very thorough with your upfront due diligence on this in your underwriting. So do you have a calculator? Have you been mentored so you know exactly what you're looking for and you're able to speak the lingo? These are the things on the front end that you really need to pin down, or you could really get yourself in trouble and overpay or not underwrite something correctly. And that mistake is going to cost you more than anything in the future, correct?
Yes.
Yeah. So G-Dad, anything else on the buy right here?
Let's stress it again. When you're starting out as a beginner, don't take expenses for what they give you. Trust but verify, and you really need to nail that expense number, because if you're off by $500 per unit, that will crush your expenses. Another thing, when you're buying in this economy, property taxes are going up. So underwrite for property taxes. Very important to do that, because they are going up, guaranteed. They're not going down.
Underwrite for future property taxes because they're gonna catch them on the sale. So what Gino's saying is what your purchase price is where your property taxes are eventually going to go, depending on your market. So make sure you're accounting for that on the front end, or you're going to get whacked.
And Jake, I'm going to give a shout out to Tyler Chesser, our broker boy. We had a great podcast with him. What he said was, it's okay to actually send over documentation. And if you're giving a quote unquote lowball offer, at least let us know why. Get your underwriting done, and don't be afraid to share that with the broker or with the seller and tell them, listen, I can't pay the price. This is what it's worth. At least you can save face. Just keep putting in those offers. I think in this economy, you're going to need to look at 80 deals, right, Jake? 80 deals to get that one. So what are you doing this week? Are you looking at one deal? Well, how long is it going to take you? It's going to take you over a year to get that deal. They're out there. You just need to constantly keep looking at deals and keep underwriting them until you find one. And the other thing I would say, Jake, is take what the market gives you. Jake and I took a pause between March of 2016 and December of 2017 because we were both pig-headed. We were both used to buying A-caps. We were like, we're not buying this stuff. And we lost a couple of good deals by a couple $100,000. We weren't assessing where the market was. The market was not at A-caps anymore. Assess where your market is right now, but always buy for value. If you can buy at current market conditions and buy for value and add value to that property, you're going to make a lot of money in this market. So don't be like Jake and Gino, where they took a pause, and we were too pig-headed, and we were too stubborn. Take what the market gives you.
Absolutely. Guys, really appreciate everyone on today's podcast. If you found value, please don't forget to give us some love on iTunes for the Wheelbarrow Profits podcast, and get ready for next time when we dive into Manage Right, and then we will get to the Finance Right portion. G-Dad, appreciate your time today.
Thanks, Stenziano. See you, bro.